Let's talk about the stock market and get your latest views. We last talked a few weeks ago. As we sit here, we have seen a bit of a rally. Is that a bear market rally and there's more pain to come? I know it's hard to say as always, but ultimately, do we still need to see an unwind, a total unwind, and some sort of capitulation from those epic bubbles we saw last, call it fall of 21?
I think defining what a bear market is really almost immaterial. You know what it feels like when you're losing money. And portfolios are down from the beginning of the year. And we're fortunate that we didn't get carried away in the work from home environment. We didn't buy the Pelotons, the Shopifys of the world. There are a lot of stocks that are down 60, 70, 80%. And they may never recover, very much like in the tech bubble of 1999, 2000, where a lot of those stocks just disappeared. But you also have stocks, companies like Google and Apple and Amazon that are very different than what was going on in 1999, 2000. They're real businesses. They are world leaders. They are the most profitable, valuable companies in the world. My sense is that the market bounced on very low volume. And there's two components of what I think we really need to see in a correction is time and price. I think we've seen a lot of the price, although we could see more. Markets can get very emotional, and they tend to get very emotional. We're certainly seeing rampant investor pessimism. The bad news that we're seeing about, are we going to have a recession? Are we going to have a slowdown? How high is inflation going to go? How high are rates going to have to go to cut off inflation? There's the Fed raising rates. There's the war in Ukraine. There's gun violence. There's all kinds of bad news out there. So my sense is that pessimism is as low as it's been, historically, that you need to see the bottoms. I don't think you've had enough time pass. I think we're going to mess around for the summer, if I had to bet. But at the same time, I think people have gotten very pessimistic about the outcome of the economy. I think that it's reasonable that we could see some moderation of the growth of profits, but stocks to some extent are already reflecting that. And so really it's going to be a matter of how high will rates go, and we're already seeing signs of inflation, early signs of inflation moderating. We're seeing slowdown in the economy in certain respects, but if you take out the build in inventories last quarter when we had, a negative GDP number, if you just take consumer spending, it continues to be very, very strong and consistent with about 3% GDP growth, which would tell you that you shouldn't have a major contraction in profits, nor should you have a major collapse in stock prices. And
yet there's still a debate about consumers. Yes, they're still spending. The data supports that. But then you've got consumer confidence in the U.S. at 11-year lows, the pessimism you were talking about, the savings rate at a 14-year low. So that seems to mean, especially lower income people, they've burned through that stimulus money from last year. Credit card debt is rising. Never a great sign. So how do you piece all that together with the consumer?
Yeah, I think what you're seeing in the headlines, you get some people get quoted saying one things, and then you actually look at what's actually really going on. It's not that bad. Consumer confidence is down from its peaks, but they're actually optimistic about the future, but they're a little bit pessimistic about the current employment situation. They're pessimistic about the business attributes. But consumers maybe are pessimistic, but credit card transactions are actually up 10% year over year. So they may be saying they're pessimistic and feeling down and blue about certain things, but they're shopping like crazy. And unemployment remains very, very low. There's still more jobs wanted than there are available people. People are getting wage increases. So I think it's easy to get carried away with the pessimism, but we're seeing it. Jamie Dimon, the CEO of JPMorgan, was interviewed recently, and Brian Moynihan, CEO of Bank of America, two of the biggest banks in North America. Bank of America, the largest credit card issuer in America. He was saying credit card transactions are up. They see it in real time. Consumers are in very good shape. Delinquency rates are in very are very, very low. We saw that in Canada too. So the banks aren't seeing the major problems. Jamie Dimon, there's this rumor that consumers have spent all the stimulus money. And Jamie Dimon said, well, actually, in 2019, consumers' average cash balances were $2,500. They're around $13,000 now. So that tells you that not everyone spent all their money. And finally, while we're seeing inflation is impacting mostly the lower 40% of the income earners, that's meaning they're pushing their spending because they're spending more money on food and gas. So they're moving down from the expensive brands, and they're focusing on the more essentials, which is going to support things like Amazon, where people are going to want to get the best deal they possibly can. So I don't think it's all negative news.